Sekar. I currently just finished the study at the MSc of Finance, Technology and Policy at the University of Edinburgh. And this topic is something that I picked up during my dissertation because it dealt with the tokenomics, although not exactly the utility token, but I present the utility token here because it's more commonly found and we interact more about that in the tokenomics. So the topic is structured as I will explain something about the velocity of money based on the historical economics part, and then how it is applied to the utility token valuation. So why valuation? So if you are familiar with the TradFi at the stock trading or the company share, the valuation models are used to assess in the fundamental steps. Like there are several steps of the trading itself, right? For example, the technical indicators, which uses the historical time series data. There are fundamental analysis, which uses the we get the balance sheet and the cash flow statement from a company to assess whether the stock is overvalued or undervalued. And there is also that I will mention later in the slide, which is the relative valuation, which uses things like PE or like price to earning multiples and stuff. So the common method is using the DCF, which is the discounted cash flow. It's very popular in the valuation analysis of the firms. That's because each company say we want to value the Apple stocks or like Tesla stocks. We know like they are publicly published the cash flow statement and also the balance sheet because they are public companies listed in the say the NYSE, the stock exchanges, or at Nasdaq. So they have this revenue model, debt, equities, working capital. But what about the crypto tokens? How do we value the crypto tokens? Because sometimes they don't have the revenue streams, no working capital. So how can we project that without any, or like with minimum data? How can we project the profit and the payoff? So these are the types of tokens, and these three I take from the journal that I used. Although by regulation, like each country can define different types of tokens. Say the BIS, Bank of International Settlement, MiCAR, the Eurozone crypto asset regulation that was just launched in June also had set different specification for the tokens. And the HMRC from the government of the UK has different classifications such as the exchange tokens, stable tokens, utility and security tokens. But these three are just the basic ones. So the cryptocurrency, which is the store of value such as the Bitcoin and ETH. Utility token is not just the platform not just the method of exchange, but also the platform native token to pay for the services, for example, such as the BNB, BAT, MANA, and the security token, which is the asset-backed tokens, such as the gold tokens, real estate tokens. And so maybe there are the specification of difference of term in coins and tokens as well. So coins are more on the cryptocurrency part, while the tokens can be the utility or the security tokens. So the history of tokenomics. So if we study about the economics and the tokenomics itself, tokenomics is the portmanteau between token and economics. So it's the economic to study or to value or to study the economic of the token. The histories actually didn't have anything to do with the blockchain at all, which was the equation of exchange, which was proposed by Irving Fisher in 1911 in his book. I forgot the title of the book basically, but it's very popular. The equation of exchange, which we are gonna see later. Basically, it's pricing the monetary unit, such as the fiat money and tokens, which is determined by the money supply and velocity. The assumption of the constant velocity. and there is like a competing theory from the Keynesian theory. Keynes is the economist from the UK, which say that this theory said that the velocity is not constant, which we can explore later. Why velocity is an important variable in this equation. And then in 1952 until 1956, Baumol Tobin developed the models for the firms leaning on holding the cash versus the investment rate. Versus the investment. So Baumol is about the firm leaning on the holding the cash versus the investment, while Tobin expanded the model on the individual level. So as in company versus the individual tendency to hold the cash versus the investment. So this has something to do with the interest rate. I will show you later why interest rate is important in the velocity as well. So basically, it's like we have cash in our bank account, and we also have investment. So why do we still have cash while we still have investment? It is like the trade-off between the liquidity value. So in cash, you can use it for paying anything, while investment actually gives opportunity gain. So cash doesn't have interest rate, but investment can give you interest rate, such as in bond or like the risk-free rate of the market. But then you can't really use that for paying something immediately. So the valuation is different. And then 1956 onwards, the equation of exchange is developed into the quantity theory of money, where it is developed in the sense of a country, which means the GDP itself. So that's why also in my research as well, I use the term token GDP, although obviously it's not representing a country, but representing the economic value of a token in their own platform. So this is like the equation of exchange or quantity theory of money is the one that we use to base the token value, the utility token valuation. So as the starting point for the equation of exchange, this is the equation M times V is equal to P times Q. Okay, I didn't put down the notation on this slide, but on that slide. If you don't like the mathematical equation, we can just focus on the diagram here. So say somebody buy something like, I don't know, like food or drink at the store for 5 quids, and then the store owner uses the 5 quids to buy something else, say checking out from Amazon or something. So although there is only 5 pounds to pay the goods and services in the economy, the GDP itself is 10 pounds. Why? Because the 5 pounds, the first 5 pounds, is to move the economy of that store, and the rest of the economy was also moved by these 5 pounds. So the same amount of money, 5 pounds, actually moves the GDP by 10 pounds. That's why total amount of money in the circulation is only 5 pounds. But the money changes hands 2 times, the first time at the store and the second time, say at the Amazon checkout or something. So the GDP, like the overall economic is 10 pounds. This is what happens when we value the tokens as well. As the tokens can change hands, especially when it's not NFT, right? Say the utility token, Bitcoin, if it changes hands several times, and that measures the size of the economy itself, not just the amount of the circulating tokens or coins, but the amount of the economic activity that is grown by the circulating tokens and coins. So the alternatives of the equation of exchange, why I put these slides up is because there is no, like, since tokenomics is a very developing and new field, it's kind of niche. So there are still competing theories about which equation that we should use. Because in valuation, in the traditional valuation itself, the DCF, the discounted cash flow, also has different style. If you are familiar with Damodaran, he's like the father of valuation from the I forgot the name. It's the university in the US, where we in the UK also followed his theory about traditional finance firm valuation. But on the tokenomics, it's not like decided like this is the single theory that we must use. So there are alternatives such as the Metcalfe's law. Basically, the network value is proportional to the number of the nodes, which makes sense because the bigger like the users and in this case in blockchain the nodes, the market sizing is bigger than just the in smaller nodes or in smaller blockchain use case. So this is like proportional to the square of the number of nodes. However, to criticize this theory is the number of nodes the only variable to value token? Because as I explained before, there are velocity, there are market cap, and so on, and the money supply as well. And the other alternatives are the store of value. So it's basically measuring the coins, because I mentioned coins here because it's the first layer tokens, or like the native blockchain tokens such as BTC or ETH, converting the value to the traditional store of value assets such as the gold or fiat currencies. And the third one is using the relative valuation. While store of value is not really applicable for the utility tokens, because the utility tokens are the tokens that we use for native payment, for rewarding the staking and stuff. So we don't really compare it apple to apple with the traditional store of value assets. And relative valuation can work because that's how we do it in the traditional finance as well, where we can compare the multiples to value of stock. Say, usually in traditional finance we have lists of companies in the same industry that we call them as peers. Say we want to value Apple, maybe we can just put everything like Motorola, Samsung, Huawei, and the rest of the mobile technology companies as the peers of Apple, and we can know from the public data what is the PE ratio, EV to sales ratio. But the challenge for the utility token is finding similar use cases. So and also it might be less useful for the fundamental valuation. So for the fundamental valuation, we can use the EOE or equation of exchange. So let's break it down. So I'm sure some of you have been familiar with the time zone. Basically, that's how we in the tokenomics quantify like the market cap. Time is the total addressable market. SAM is the serviceable addressable, and SOM is the serviceable obtainable market. Basically, it's just the subsets of the markets that we want to quantify. If you want to pitch to the investors, for example, usually these numbers are the ones that presented by the founders. Like this is our market cap or target market. So the PQ here on the right hand side of the equation quantifies the market cap, like the SOM, the serviceable obtainable market. It's the multiplication of price of the unit economy times the quantity. It's just like the one that I showed you. 2 transactions, each costs £5, so like 10 pounds, which is the market cap. And then also the M is the network value, basically like the amount of the economics that is supported by the tokens. And the V is the token velocity. So M is equal to the market cap divided by the velocity. M here is the 10 pounds divided by 2, which is 2 times change hands. So the network value itself is 5. And then next on is the zooming in on the token velocity. So I needed to put up this slide because if you want to read online, there are actually competing opinions of the thought leaders. Say, for example, the article from Vitalik Buterin, the founder of Ethereum, actually zooms in on this velocity that velocity is a variable to control, because say if you want to increase the price of the utility token, you want your token to grow up in price, right, in value, you need to decrease the velocity. But it's a bit counterintuitive, because when you build a token to be used in your platform, you want the use case to grow forever. So sometimes there should be like control, like buterin, or maybe the other guy, Kyle Samani actually refers it to Goldilocks zone, or basically like a middle ground where it's not too high because it will lose its value, or not too low because the economic will not be sustainable. But actually, if we zoom into the equation of how to price a token, the economic value divided by the number of supply, or like the float supply of the circulating tokens, actually it's more control of the scarcity and the number of tokens itself, rather than the velocity. So velocity is something that is impacted by the supply, by the available supply. So what can we do with the token velocity? We have understood what the token valuation, so it's a variable in one of them. And there is this Cello Refi CBDC project. I also managed to benchmark it as well. They actually create the stable coins CBDC for basically they place the demurrage fee, or like the tax fee, of the tax for the hoarding. The hoarding here is, say, in the recession, people tend to withhold their money in cash, so they prefer cash, and hoard their money, which is understandable. And we cannot impose the negative tax rates, as in cash itself doesn't have any tax rate. But if you can, CBDC is not something that is difficult to track, because it's available on blockchain, and blockchain data is accessible to public. So you can tax the CBDC itself if you hold it for more than X number of days, for example, or number of months, something that is to be decided by the central bank. And the money, of course, just like how they do with the tax, the money can be used to stimulate the economic growth with something else. So it's called the demurrage fee. I recommend you to read on the Cello white paper to read more about this. And so where can we get the velocity data? The comparison for the fiat money, this is the Fed, the St. Louis Federal Bank, it's in the US. The comparison is the fiat money, because this data is published by the US institution. For example, the M1, M2, and MZM, it's basically just their, their categories of USD. Say M1 is notes and coins, M2 is M1 plus some small denomination. They publish this data, so it's very easy if you want to study economics and get the velocity data for the fiat money, say the USD. But for tokens, if you don't have the tokens itself, say you want to build your token and you want to estimate the valuation, there is no available data, you can use the proxy, which is the empirical or DIY, do it yourself. You can get the Google BigQuery for the on-chain public data using proxy like USDC or USDT, basically stablecoins, to get the sense of the stablecoins instead of your actual tokens. That's what I did. I followed some available code by Michael Sapkowski. I'll show you. That's on the appendix. You can use it on Python or something for analysis or SQL. Because Google BigQuery actually displays the data for the on-chain Ethereum. And this is the example. So I took it from from the CryptoQuant, accessed on last week. So this is for Ethereum velocity. You can see that the trend was just picking up and then gradually decreasing. So the hypothesis was in the Q3 of 2021, the DeFi faced the booming of the dApps, And then, of course, the Ethereum was the currency to be used for building the dApps. That's why the velocity was higher back then, and then gradually decreasing because of the increased hodling. Of course, maybe the further analysis prove it otherwise, like maybe there are other causes. And this is the BTC, a bit different from if it picked up during the Q3 of 2022. My hypothesis is about the panic sell-off. So this is the thing about velocity. It doesn't matter whether you sell or buy. Velocity is the amount of the token or the coin changes hands. So whether the activity is selling or buying, it's still counted as change hands. So my hypothesis was it's after the Celsius network crisis, and since we know that it's halving, so it with the increased hodling, it will just reduce the velocity, and because it's like limited number of supply, so it will decrease the velocity. And this is how the summary of the valuation that I did as well. So for the MV is equal to PQ, you can estimate the Q, number of total transaction, estimate the P or the financial quantity, like the financial or the economic value that you can represent by the token. And then you can get the V data from proxy, or if the tokens are already there, and you can track the token from Etherscan, from Google BigQuery. Then you can get the V data, and then you calculate the M, and then you calculate the price of each token by dividing the M with the number of the supply in the flow. And then since if you want to follow the DCF method in the annuity, I can show you on here. There is this contemporaneous value of token. Contemporaneous is basically if you do the annuity method, you can project the value of the token like every month or every year, but then you have to bring it back to now, discounting it to get the present value. So if you are not familiar with what is present value, what is the future value, present value is say we like, well, how can we say it? We can discount the future value because the money value is valued more in the present, like because you can use the money to invest in something else. But the future value has to be discounted to be brought back to the present. And this is basically like a summary, because modeling this kind of valuation is more of art than science. As I shown you before, it has the assumptions, it has the velocity that was derived by the stable coins if you don't have the token yet. So yeah. And this is the example of the code I used in Python. Say I used the Google BigQuery for the USDC, January till May. Yeah, basically you can just filter out, and then the rest of the, so this like, for January till May itself, I filter out the USDC data, and it has like almost 11 million rows. So imagine how slow your computer might work if you want to analyze this kind of data. So that's why, yeah, if the data is already available from the platforms like June, CryptoQuant, you can just use the velocity data from them. I think that's all, the presentation. Thanks very much again for giving me the question.